Jeff, current accounts out today, really in line with expectations, 3.2% contraction in the third quarter, and the market was looking for a number of around 3 to 3.2. What was your expectation there?
Well, we had thought it was going to be a little bit worse, so we're very pleased to see it as low as it is, even though it's only a small improvement from where we were in the second quarter. Remember, we were a lot worse than this a year ago, and that's critical when we think about things like the outlook for the rand. Last year, this time, the rand was under a heck of a lot of pressure, and it really seemed to find it difficult to find even a top as it continued to weaken. Now, of course, the rand very strong. Not great news if you're an exporter, but at least a sign of confidence in the economy.
Of course, as you said, last year, this time, the current account deficit much larger. In fact, at the end of last year, I think it was around 7%. Do you think that as we head into 2010 and the economy globally starts to normalize, that we're going to see our current account deficit swelling back to those levels again?
Well, of course, as the global economy normalizes, that's actually a benefit for us. How so? As the global economy normalizes, so does demand for our exports, and we've already started to see that in some sectors. What will be more critical for our own current account, I suppose, for our own current account, what will be critical is what happens with our own demand. Will the recovery in the South African economy be the sort of recovery that means that we start buying the kinds of things, either companies buying machinery and equipment to rebuild their productive capacity, whether it be people buying new cars and large televisions, will we be buying the kinds of things that starts to see our import bill rise and get us back towards those very high numbers? My sense is that our current account deficit is going to remain pretty small for quite a while, maybe not at this 3.2% of GDP level, but certainly in the 4s, and that's a very favorable environment for the currency.
Of course, we do know that government is spending on infrastructure, is going to be importing machinery as well. Do you think that's going to be one of those factors that helps that current account to swell back above 4 or 5%?
Well, on the government side, we know that they're already importing lots of stuff now. You know, ESCOM is, Transnet is, all of this spend around the World Cup, all of that's very import intensive. What will be the swing factor, I suppose, is what's going on in the private sector, because during this period where the economy went into a bit of a dive, during this period where businesses weren't very confident, and during this period where it wasn't the least bit clear you were going to be able to sell the things you produced, what we've seen is that investment on the private sector side, the investment on the private sector side has really plummeted. And that's been the big swing factor. So I would expect as we go into next year, government investment spending or public sector investment spending is likely to remain very strong. We'll start to see companies get a little more bullish, their future outlook. And as that happens, we'll start to see the cranes come back. We'll start to see imports on that side rise. But again, I think it's going to be fairly modest. The swing factor might well be the consumer. Back a few years ago, when the current account deficit was so large here, we were buying a lot of TVs, a lot of refrigerators, a lot of new cars, a lot of toys. And that sort of behavior is unlikely to return anytime too soon, I think.
Well, just looking at the quarterly bulletin today, household consumption is still very much under pressure. We saw those retail sales numbers yesterday, the private sector credit extension data last week. So it looks like the consumer's really not willing to join this party yet, is he?
Well, certainly it's going to be a slow recovery on that side. The quarterly bulletin had a whole host of very interesting information on that side. One was looking at debt. So we know that debt as a proportion of disposable income, that's pretty much near its all-time high still, around 79–80% of disposable income. But debt service, the amount that you pay each month to service the debts that you have, that's come down quite considerably. The tail end of last year, in the fourth quarter, it peaked around 12% of your disposable income. That's fallen down to about 8.5% now, and that's helpful because that's a little bit more money back in people's pockets. You see that with your mortgage bond, you see that with your credit card payments. What does that mean in terms of spending? Well, you're quite right. Consumers aren't spending very much right now. What we saw in the data is a contraction of 2% Q-on-Q at an annualized rate. But when we look into detail, what we've seen, interesting enough, is for durable items, things like cars. Durable item spending has actually increased in the quarter for the first time in quite some time. And that suggests to me, at least, that the interest rate cuts are filtering through, that consumers aren't under quite the same pressure now as they were a quarter or two ago. Again, it's a long way away from where we were in 2004 and 5 and 6 and even 7, but it's also somewhat better than where we were in the first parts of this year.
Jeff, we have to leave it there. Thank you very much for your insights this evening. That's Jeff Gable. He's macro strategist at ABSA Capital. Still with us in studio, of course, Etienne Nel from BJM Private Client Services. Etienne, we have the futures close out next Thursday.
Yes.
You're not going to be around because you're going on holiday. the end of this week. What would you be expecting there? Do you think investors are already squaring positions ahead of the end of the year at this stage?
Usually in December, Stephen, we do see futures players squaring positions ahead of the December closeout, and tends to be a bit of a slightly damp squib compared to, let's say, some of the other futures closeout where we've seen 23 billion rands of turnover. So it wouldn't be surprising, especially after the year we've had, to have a fairly muted closeout.
Mm-hmm. Just perhaps looking at today's action, we had quite a negative week so far. Today we have turned around a bit, closing about 2/3% higher. I mean, do you think that the market is starting to stabilise following the sell-off that we did see earlier this week?
I think so. We certainly haven't seen any bad news hitting the markets. We haven't had any reaction. Foreigners definitely are taking money off the tables, as I mentioned earlier, and we are seeing it in the flows. As a result, market volumes under a bit of pressure, as well as the indices and some of the bigger counters, typically, SAB coming out with that empowerment deal, and the share price, having peaked at 225, I think closed at 216 today. So we are seeing some liquidity being pushed back into the system.